Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch, the insider's guide to property investing. He's Ben Kingsley, I'm Bryce Holdaway, and we are coming to you from the Sydney Property Buyer Expo, where we've just come off stage recording an episode of the podcast with Dr. Andrew Wilson.
The doctor was on.
The doctor was in the house.
So much great content, really tremendous. Passionate, actually, quite bullish on the market, wasn't he?
He was. He gave some insights all around the country. But one thing that you can never accuse Dr. Andrew Wilson of is not being passionate about the answers that he gives to the questions we ask. So
and in fact, some detailed responses there as well.
Very deep, but it's definitely worth the effort because there is some gold content in it.
Yeah, we looked a lot at Sydney. We also did a couple of viewer questions, listeners' questions, one on Perth, and we also had a look at the Melbourne market as well. So there's some really great stuff there.
There is some really great stuff. There's a bonus. Stick around to the end of this podcast also, because we know that we're going to give you some free content from the good doctor himself. Some really awesome slides that he's made available exclusively to the Property Couch listeners.
So let's get into it.
So I hope you enjoy the next 35 minutes, and remember to stick around to get that content at the end.
Hands up those people who are Property Couch listeners so far.
Wow,
wonderful. There's a few of you. Thank you for joining. Well, obviously, Ben and I started the podcast back in February last year, and it's now approaching, by the end of the year, we expect it to be about 1 million downloads. So thank you to you for listening. But today we're really excited because we've got the Chief Economist from the Domain Group, Dr. Andrew Wilson, who's I've heard speak many times. I never ever get sick of hearing what he has to say because he's a man who loves property, and he's a man who's passionate about the outlook of Australian property. And so, Andrew, we should open the batting by why are you so optimistic with the Australian property outlook?
Well, we only have to look at history, really, Bryce, to see that, and as I always say, that I think history shows us what a resilient and robust investment vehicle residential property is, and it's not just a question of economics, it's also a question of our, I guess, inner connection to property investment. And as I frequently say, that if we think about our backgrounds, that most of us come from Anglo-Saxon or Southern European or East Asian cultures originally, and I think that we always have that sense of the sanctity of bricks and mortar investment, and I guess it always becomes a cliche when we think of those terminologies such as bricks and mortar, the safe as houses. When I do, and I do occasionally, debates with our fraternity from the share market.
Seen a few of those.
Yeah, and it's all good, love them, but they have their role. And when we sort of say about these truisms that reflect property investment, such as safe as houses or bricks and mortar, we don't sort of get the same sort of vibe when we say safe as stocks and shares, or and I think that does reflect that we have this inner connection to the sense that that bricks and mortar investment does have that robust, resilient, and solid longer-term outlook and results, and I think that does again reflect that the sense that we have that owning property and investing in property really is, from our backgrounds, almost a guaranteed a roadway to prosperity and wealth. And I think that's part of what does drive investment in property, not just from owner-occupiers, but particularly smaller scale investors in our markets. And this is the other point in terms of our future is I think we're not just tapping into that underlying sense, that DNA connection to property investment, but we're also seeing that the times are starting to favour property investment more and more. And I think Australians are going to grow to even higher levels of being small-scale investors in property. And that's a result of how our economy is evolving and all the advantages that we do have in terms of tax advantages, particularly in residential investment. And I think that we're seeing that now, and particularly, of course, in the Sydney housing market, which is investor central, has been investor central for the last 4 years and rising again. And I think that, that we will continue to see that as a significant driver of our economy, our housing market and our investment choices.
I agree with that, and I think the most important message there is around its essential need, it's shelter. Now we've got an ageing population, and with that ageing population, what's also happening there is we're going to be in a situation where we have to support that ageing population and support them from a pension point of view. Now how do we do that? Well, we're not going to have enough workers, so if we see all this transition of the baby boomers into retirement, we need to bring migration into the conversation, and that's exactly what we're seeing. In fact, all of the forecasts around population growth are starting to see that we should see our population double over the next 40 years. Now, everyone has to live somewhere, so that reinforces that essential need of shelter, doesn't it, Bryce?
Yeah, certainly. And I guess, were you surprised that Melbourne and Sydney's results this year, given that a lot of the forecasting from last year was that maybe it might have come off a little bit, but I guess with low stock, low interest rates, people are just thinking, well, I'm going to stretch myself.
Well, look, we had, obviously lower interest rates was always going to be a factor in increased house price. I mean, that is the cause and effects typically of our cycles, but it doesn't mean every market rises at the same rate as interest rates fall. It is about those local supply and demand factors. Now, what we're seeing now is it becomes more and more about the local supply and demand factors rather than the improved affordability from lower interest rates. And we see that with Melbourne and Sydney clearly moving ahead of the pack this year. And in Sydney's case, again, it is a return of the investor into the Sydney market. We see investor levels now in Sydney pushing up again to 60% of market share. Of course, at the peak of the boom last year, investors made up 63% of all lending activity in New South Wales. And that was the big difference in price growth between Sydney and the other capital city markets. It was the level of investor activity. Now, we've also seen investor activity rising in Melbourne. But what Ben absolutely said, which hits the nail on the head, is these things are significantly being driven now by population growth. And it's no coincidence that both Melbourne and Sydney are at the head of migration levels at the moment. Now, at the moment, around 1,100 people are moving into Sydney every week. 1,100 every week. In Melbourne, it's around 1,400. Now, as Ben said, you've got to live somewhere here, right? And the Sydney equation, the Sydney conundrum, is that we clearly have too many people and not enough houses. And that imbalance is continuing. And that's why all the chat of oversupply of the Sydney market because of these record levels of units we're being approved is complete nonsense and will be revealed again as nonsense over the next few years. I mean, we are just struggling to match existing needs of our population for housing, irrespective of the surge that we're getting in migration. And that migration will continue. Sydney has the strongest economy. Melbourne's economy is strong as well. We've seen a shift from the fly-in, fly-outs from the booming mining states of previous years. They're all switching around now, looking for work opportunities, particularly in the construction industry in Melbourne and Sydney. And of course, this will continue. New South Wales is particularly well positioned to be a robust and resilient economic centre because it's not just a mine or a building site. It has a number of significant economic drivers: agriculture, mining, tourism, construction. All these factors are evenly balanced, which will keep population growth and those job seekers moving in, particularly to the Sydney market.
So Andrew, you're saying this, and we're seeing, as you say, the sort of percentages of lending getting up towards that 60% to an investor, when traditionally it's basically 70-30 or 60-40 in traditional times. Are you concerned around the marketplace is going to overshoot itself? Do you think that at the end of this cycle we'll start to see some correction?
I think what we're seeing in terms of the cycle will be a different cycle going forward. I think the volatility of the cycle is something that will become a factor of the past. And this is because our economy is changing. Hello, Australia, join the real world. I mean, we've had China driving us against the flow of economic activity in other advanced economies for the last 4 years. Now, that's finished. Thank you, China. We appreciated it at the time. But all good things come to an end. And now we're transitioning back into another type of economy. But we're a hostage to international forces. And we are seeing downward pressure on interest rates. Our interest rates have fallen substantially over the last 4 years. It hasn't been just to keep Sydney homeowners happy. It's been to try to reinvigorate and reinflate our economy in the face of the end of our resources boom. And this is still a journey. I believe interest rates will continue to fall, but what we will see is a flattening of the economic cycle. And that means we'll see a flattening of the house price cycle. But as I said originally, I think it will become more about local factors and local cycles rather than an overarching cycle. But make no mistake, the Sydney housing market is, the long-term journey will be a higher proportion of investors through the cycle. The Sydney market, in my opinion, will become, I think certainly by 2030, we will have more property owners in units than in houses, so more units than houses. And I think by 2040, we'll have more tenants, that is investors, than owner-occupiers in the Sydney market. Now, you might think that that's an extravagant prediction, but we only have to look at New York to see exactly the same circumstance. I mean, Sydney is the New York of the Southern Hemisphere. New York has the highest price of any of the American capital cities. It also has the lowest home ownership rate. And we are heading to low home ownership rates here. Yes, it's a tragedy for first home buyers. At the moment, we have just 4.8% of lending, as we have nearly 60% for investors. We have just 4.8% of lending to first home buyers. That's near a record low. And folks, don't think this is going to recover anytime soon. To get first home buyers back into the market at the average levels of around 13%, the long-term average levels, we'd have to see Sydney house prices fall by around 30%. That is not going to happen, believe me. So the future is that we are going to see higher levels of tenants, which means more investors, and tenants will be renting for a longer period of time, maybe for life, which means that the Sydney market will become the same fertile environment for investors that the New York market is. And I'm absolutely confident that this is our outlook.
So where do you see the growth in housing price coming from then? We've had interest rates driven down to historic lows. We've now got 2 professional incomes in each household, so we've organically grown household cash flow. And you talked about 1,100 in Sydney, 1,400 in Melbourne. The apartment makes sense because that's an affordability story. Where does the house price growth come from if you don't have a massive growth in wages?
Well, look, prices don't grow from the magic pudding or rub the magic price bottle. Prices only grow because you get lower interest rates with the fixed income or higher incomes with a fixed interest rate. I mean, we're very fortunate. I mean, we love to bag the banks, but we're very fortunate in this country, and that differentiates us from other advanced economies and housing markets, that we have a very rigid lending environment. I mean, the banks aren't going to lend you more than 80% of their valuation unless you take out mortgage insurance, and they're not going to let you repay more than 25% of your income with your mortgage repayment. And they don't have to create any type of insight into the market because they have such strong market power that they don't need to move with market dynamics. Now in America, where the market rose, because they have a market-driven finance model, banks there or financial institutions competed by offering higher LVRs or higher proportions of your income for your repayments, right? Now that was great while prices were rising, but when the market flattened out, of course, it meant that high LVRs and lower income proportions meant that was a fertile ground, for a shakeout in the housing market. Now we don't get that here because our banks have this rigidity in their lending. And look, we hate the big profits the banks make. Yeah, whatever. Let's have a Royal Commission. Yeah, whatever. But at the end of the day, it's all that market power that keeps our housing markets in balance. They won't take risks, and that means that we don't take risks. So they don't allow us to take risks because they won't take risks. But what I'm saying here is that with that rigid lending environment, the only way prices will go up is if interest rates fall or incomes rise. And I think the differential in terms of the cycle going forward for investors, just so I know it's been a long journey to the answer of the question, but that's me, folks. But what I'm saying is it's the taxation advantages that investors have that will always give them that 1 or 2% margin for prices growth over and above what the underlying inflation rate is in the economy. So if our inflation rate is falling down towards 1 or 2% as it is now, then the underlying returns on investment will still be 3 or 4%. And I think that in terms of capital growth, and also the leverage that investors will continue to have over and above underlying yield, will also give them that extra 1 or 2%.
So I want to pick up on that point. There's a couple of points I want to pick up on, which is really great. Because you've got to love his passion, don't you? I mean, it's just incredible in terms of what he gets on with. So a couple of things there. So the rising tide that's lifting all ships at the moment is a consequence of lower interest rates and good economic activity in
local centres. Exactly.
So what Bryce, I think, was alluding to, and what we're also trying, because the science of picking an outperformed property, at the moment, you could pretty much buy anything in Sydney or Melbourne and you've done all right.
That's right.
But over time, obviously, as incomes start to slow, which we're seeing now,
absolutely,
we're seeing no income growth, and we now need to be very particular, because we do know that based on scarcity and based on convenience and proximity and income, there's going to be some areas that won't grow as well as others. Do you believe that that's the case?
Yeah, absolutely. And again, it gets back to that economic equation. Now, if we can compare Melbourne with Sydney, now Melbourne is currently growing at a faster rate than Sydney. Now, Sydney's back in town. The boom is back. Don't tell anyone. We're releasing our house price report next week. I think we're pretty clear with 80% clearance rates we're going to get some pretty serious price growth back in Sydney. Now, Melbourne is growing faster than Sydney, but Sydney house prices have increased by nearly 70% over the last 4 years, which is quite remarkable. Melbourne house prices up by around 30%. So Melbourne's been in a little bit of catch-up mode. But you've got to understand what I said before. Those underlying drivers of the Sydney market will remain at a higher level than any of the other capital city markets. Now, Melbourne at the moment is just a big building site. That's fantastic. That's driving their economy. It's unleashing a lot of growth potential, particularly in the outer suburbs, which were quiet for a couple of years because of an underperforming economy. But with more building workers, tradesmen are now starting to buy and sell property in those outer north and west suburbs. So it's in a catch-up mode. But Melbourne still remains a bit of a one-trick pony. Maybe education, maybe construction. Now, when that construction cycle starts to wane, it means that the drivers aren't as strong, and there aren't the other drivers that the Sydney housing market has in terms of economic growth. And that's the key difference with Sydney and the rest of the country, is that it can sustain its job creation environment and keep attracting people into the Sydney Basin to live, even though they may be renting and not buying, if you understand what I mean. But if they're renting, that's fertile ground for you guys out there who are investors.
How do you see that impacting if there's a huge spotlight on Melbourne and Sydney? On the other cities as a comparison, they seem quite undervalued, but they don't have the capital, the big multinationals to drive those six-figure incomes. So,
well, there's no doubt that Melbourne and Sydney have moved clearly ahead of the pack in the cycle. I mean, real house prices have actually fallen in Hobart, Canberra, Perth, Darwin, and Adelaide. They've fallen since this cycle, the previous peak of the cycle in 2010. So there's been no real great surge in growth. And this shows you that it's not just about the lower interest rates improving affordability, it's about those local conditions. And more house price growth will reflect local conditions rather than the interest rate differential, the interest rate driver. And that's why we've seen Sydney push ahead of other capital cities so strongly, and as a result of more investors. But having said that, we are still seeing higher levels of investors in those capital city markets that are still underperforming. I mean, even the Perth market is attracting investors now. And this is the future. You go to your accountant or your financial advisor, and they'll say to you, look, why don't you think about getting an investment property? You know, the yields, they're 4 or 5%, but they're a lot better than you're going to get anywhere else. We can set up your tax position so that you can negatively gear. You will accrue capital gains. Look, they're not going to be double figure, perhaps, as Sydney has gained over the last few years, but they'll still be those 3 or 4% growth through the cycle, which you can build on, and compared to the sort of returns you will get in other investment instruments, particularly fixed income returns like cash deposits. Term deposits. They're going to be. Now look, we talk about yield. Everyone's saying, oh, I hear analysts say that, oh my God, yields are so low. How could you possibly be interested in residential property with a 4% yield? What are you getting in the bank? Now look, I've got a model on my presentation which I ran, which models the returns on the averages from the Reserve Bank, the average term deposit interest rate for a $10,000 fixed term over 1 year, or over 1 year term, right? Now that's currently at 2%, with yields, the average Sydney yield for a dwelling at the moment is 4%. So there's that 2%, 4% differential. Now if you go back to the previous boom in the early 2000s, it was the other way around. Now this is the difference in our economy now. Because rates are so low, the point is that yields haven't fallen at the same rate as deposit rates have. They've actually held their own, right, whereas deposit rates have fallen away. Now we've got a 50% gap between what you get at that fixed term deposit in the bank as to what you get in a yield in Sydney, which has the lowest yields of all the capital city markets. This is why more and more investment decisions, and it becomes almost, osmosis, intuitive, that you think, gee whiz, property investment, I can still get capital growth, but I get the tax advantages, negative gearing, discount on my capital gains, tax depreciation, and compared to this low growth, flat economic environment we have, it's just a no-brainer. And of course, we're also exposed to the stock market, most of us, through our superannuation. So it means we're diversifying. We've got our super reflecting the stock market, and we have these portfolios that we can develop in residential investment. And believe me, the government is not going to touch in a significant manner the tax advantages for small-scale investment.
So we see in the cycle too, because what we calculate yield by is the value of the property over the rental return that we're going to get. So if the value of the property is growing, the yield curve actually goes down.
Yes.
Because we're not setting it from a fixed point. It's not when we buy it. So all the data that's coming through is basically seeing the value of the asset grow and the yield curve coming down because the value is growing. So rents aren't growing as high, but over the cycle, once we come off that growth cycle, the yields start to play catch up.
Exactly. And the other point is, that, which is different now, you've got to understand the other point to yield is return on investment, which is rents. Now rents are not going to continue to track house price growth. There is going to become more of a differential for the very reason that incomes are flat. Now, tenants are different to home buyers. Home buyer can borrow, they can leverage their existing property as a deposit. Now, a tenant doesn't have that capacity. All they can rely on to compete in the market is incomes growth. Now, just because there's 20 people in the queue for your property that you want to rent, that you go and have a look at Saturday morning, and you really want it, but you can't pay more because you haven't earned more to be able to leverage yourself at a higher rent. Now that's what we're seeing. Flatter rental growth will reflect flatter incomes growth. Okay. Now I do think there's some upside to rents in markets such as Melbourne and Brisbane, although Brisbane is more of a balance between demand and supply. But I think that the Sydney market, that rents will continue to be flatter because of the lack of incomes growth there to sustain or to push up rents, despite there being an underlying shortage of property. Now what does that mean? It means there's a flat line for your return on investment. So even if yields fall, the only way they'll fall is if prices keep rising. And hey, that's going to make you really sad, isn't it? If prices are rising. So the yield equation is sort of is now taken off the table because you're basically getting a guaranteed return on rentals. And we talk about units. Now we're tracking at the moment the median house rent for a house in Sydney at $530 a week. Now that's 30% higher than Brisbane and Melbourne, which are $400 a week. Poor old Sydney tenants, who earn just about the same amount of money as the tenants in Brisbane and Melbourne, are actually paying 30% more to rent a property. But what we're seeing, a big difference in Sydney compared to Melbourne and Brisbane, is unit rents in Sydney are almost the same as house rents in Sydney. In fact, we've got the median unit rent in Sydney is $525 a week. It's just $5 the difference. Why? Because tenants can't afford houses anymore. We even saw vacancy rates slipping upwards for houses over September, up to 2%. Now that's the highest in a year, but we saw vacancy rates for units tightening down to 2.1%, which is also the lowest for a year. So what this shows us is this switching across from houses to units because of affordability. And again, this makes a nonsense of the perceived, of the chance, the doomsayers, of oversupply in the Sydney market for units. We just can't get enough. So what we're going to see really is this convergence, which we're seeing already almost, of the cost of rent of a unit for a house. So that means it's the same. What we'll see is yields on units and houses will start to get closer together as well. And again, this will be another driving force for more investors into the Sydney market.
So folks, we'll throw it out to you shortly. We're going to have a mic running around to see if there's any questions that you want to ask Andrew, but we've got one of our loyal listeners has written us a question and said, I know it's not a favoured city at the moment, but it would be good to hear a bit about Perth and the surrounding markets, even though we're not on the same level as the East Coast.
Well, look, there's no secret that Perth has suffered from what has been a very significant downturn in its economy. Do you know the Perth unemployment rate is now 6.6%? Now, a couple of years ago, we would have said, oh no, what are you smoking, buddy? Because we had unemployment rates in Perth in the 3s. That's where everybody was heading, remember? I mean, you want to earn $150,000, go over to northwest Western Australia, sweep out the sheds and you're on $3,000 a week, right? And everybody headed out there, of course they did, the fly-in, fly-outs. Now, unfortunately, all good things come to an end, and we're having the hangover after that great party. And it is because of the end of the mining boom. And the fly-in, fly-outs have flown in, flown out, and they're staying in Melbourne and Sydney now. And that, of course, has meant a significant falling away in demand. Now, particularly demand in the rental market. Now, at the moment, there are twice as many empty houses looking for a tenant in Perth than there are in Sydney. Okay? So that's a market that is now adjusting from a very strong growth period. It needs to find a floor. And the thing that also it needs to find is a little bit of confidence. It is an economic equation. It is an economic issue. When that unemployment rate starts to fall, then you'll see a turnaround in migration. Then you'll see a fall, a flattening of the housing market in Perth. But, if property investment is for the medium to longer term, you can buy properties now in Perth at prices that are lower than they were 5 years ago. And yes, it is going to be tough to find a tenant, and you do have to take a longer term view. But the other interesting thing in Perth is, guess which capital city has the highest proportion of first home buyers? You see, so there's some good news there for those that are wanting to get into the market. 20% of that market are first home buyers at the moment. And of course, numbers for investors are lower. But it is a transition. Cycles don't all move at the same rate. And this is what I say. It is about those individual supply and demand factors. And some are positive, such as Sydney, and some are negative, such as Perth. But over time, they will work their way back to a floor and then start to grow again.
So Andrew, we're here at the Sydney Property Buyers Expo.
Yes.
We're speaking to the converted. Most of the people here have a bias towards residential property, and obviously you've been pumping the tyres up. Is there any danger points? Is there any factors that you see, any risks in any markets, and what are they?
Higher interest rates. Is that a flying pig? Higher interest rates. They're always the enemy of the housing market, are they not?
Yes.
But folks, there is no... If anybody says to you, oh yeah, but what if interest rates rise? Well, you say to them, yeah, well, if interest rates rise, we're going to have a huge party, and let me tell you, I'm the one who's going to fund it. Because it will mean our economy is finally out of the mire. We're finally starting to grow again. Consumers are spending again. Businesses are investing again. Prices are rising. We're starting to feel good about things. The Reserve Bank's getting a little nervous because inflation's starting to kick up. That would be good news for all of us. Unfortunately, we are not going to see interest rates rise again unless we get a currency crisis, and then who cares, for a very long time. I mean, the US have been trying to get their interest rates up for 2 years now. They decided to raise interest rates at the end of last year after 12 months of navel-gazing. They put them up by 1/4% and panicked all through this year because they continue to see an underperformance from their economy. Now, they may want to raise interest rates again in December, but it's a tough call for them because they are concerned about flattening what is still a very weak economy. Now, Australia, last Thursday we had the unemployment numbers released, right? Now, the unemployment rate fell from 5.7% to 5.6%. Great news, lowest in 3 years. But if we have a close look at that data, we can see that the Australian economy is continuing to shed full-time jobs. This is bad news. All the employment growth is coming out of part-time employment. So employers are saying, look, I can't afford to give you a full-time job. I haven't got the work, right? But I don't want to lose you, so we'll put you on part-time. And this is another flattening of incomes growth. So we will see lower interest rates before we will see higher interest rates, believe me. And both ways is not good news. But if we get higher interest rates, it will only be because of an improvement in our economy. And it's something we should be embracing as a positive, not as a negative. But that is the factor that would push, obviously, prices downwards in property markets.
Well, as we throw it over to the audience, I've got a quick one for you, and put your hand up if you want us to get the mic to you. I've got one at the back. I've got a question here from Joseph. Can you ask the doctor how Domain derives its clearance rate?
Okay, well, every Saturday we have a team of people in our offices, and we ring around our agents to get results from clearance rates. So then we report our Saturday clearance rate, which is a Saturday clearance rate. Now, typically we get around about 60% of listings, 65% of listings reported to us of a Saturday, and we record our clearance rate as a result of that. So it's the sales, including the withdrawals, versus the reported, okay? So the point about the interest rate, and of course there has been some questioning about the methodology, but the point about the methodology isn't so much the actual nature of the methodology, it's the fact that it's consistent from weekend to weekend. So we are measuring the same, we're using the same process to measure the auction market every Saturday, every Saturday, every Saturday. So whether it's 80% or 85% or 60%, it's relative to every weekend using the same measurement process. Now, as long as we're getting at least 60% of the reported listings, we know that that's a robust reflection of what's happening in the marketplace. Now we move on. We don't report the whole week, as others do. We just report the Saturday snapshot, and then we move on. We don't report, or I don't report on the full week's results, because that's a different methodology. And you always see a lower clearance rates when you get the full results later in the week. And that's because agents are human beings, I think, and they tend to obviously want to report sales rather than listings. So early in the piece, they'll report a sale rather than a listing, are more inclined to. So those clearance rates, the full clearance rates, always tend to be lower than the Saturday clearance rates. But that doesn't matter, because we only report the Saturday clearance rates, which uses the same methodology.
Lots of gold here, folks. Very passionate. So we've got a question here.
Sonia has a question for Dr. Wilson.
Hi, Dr. Wilson.
Hi.
Hi. You're very passionate, and I love listening to you.
Thank you.
I have a question around Darwin property.
Darwin?
I have an investment property over there, which I bought a couple of years ago now, and it has dropped, and I've had to reduce the rent.
Yep.
Where do you see it going?
Well, look, obviously, I've just come back from Darwin, and it's a market that has been a very tough market. It's, I guess, the Perth of the North. But a lot of the mining centres are struggling at the moment, and it is because of a significant fall in population growth, or migration particularly. Now, the Darwin market has fallen, similar to Perth, same reasons as Perth, but there are differences in the Darwin market compared to Perth. The first one is that Darwin still has, of all the capital cities, state and territory, Darwin has the strongest economy. Unemployment rate in Darwin is under 3%. Still a very strong economy. Now, it was always going to be more volatile because it's a smaller market, and therefore when you get people leaving, or not the same numbers coming in, it would have a more severe shorter-term effect. Now, some early signs that market is starting to bottom out. We're recording now a stabilisation of vacancy rates for houses in Darwin. So there's now, and vacancy rates are the first sign that you should always look for in a market that's starting to bottom out. Now, vacancy rates in Darwin are now starting to look a lot more reasonable. They are in the low twos, and I think that means that investors are starting to find tenants again in that market. And also, I think the Darwin market certainly moved ahead in terms of its affordability. I think it's getting back to a more normal market in terms of what the locals can afford to pay. So it's still a journey, but there's no doubt that there are the better early signs in the Darwin market now than there are in the Perth market.
That's a very impressive effort to keep going over that voiceover, because I haven't seen anyone do that successfully today, so well done.
Well, mate, you know me.
Last question over here.
Yes, Just as a foreign buyer, should I be investing in Sydney or Melbourne? Because I don't really follow the market.
As a what buyer, sorry? As a
Foreign.
Foreign.
Oh.
So we've got to buy new, is what you're saying?
No, established.
Established. You're allowed to buy established?
Yeah,
Yep.
actual.
Well, you're not a foreign buyer, eh?
No.
Well, look, look, it depends on, I think both markets, over the longer term, Sydney has a better price outcome, I believe, only because of those factors I mentioned, which are a better performing economy in terms of the drivers. However, the Melbourne market is, 750,000 median versus a million point, nearly 1 median, right? So there are affordability advantages in Melbourne, and that's part of what's driving more immigration into Melbourne, is it's a more affordable market for those looking to shift. So it depends on where you look. I think a longer term view is always the Sydney market, but there are certainly opportunities in Melbourne. We've seen the west, the southeast and the north growing quite strongly in the Melbourne market recently. I think there are still affordable options there, but I think there's not a lot of difference over the medium term, but certainly over the longer term, I'd be picking the Sydney market, but you'll have to pay more.
We'll sneak one very last question in, but have you got a view on the interference with APRA into the lending environment?
Well, look, APRA have got a brief that says that they have to maintain the stability of our banking system. You can't argue with that. And fair enough, we did have high levels of investors last year. My problem with the APRA policy is the same problem I have with interest rates. It's a blunt instrument. It's a one-size-fits-all outcome policy. So APRA last year initiated actions through the banks that raised interest rates. Yep. Now, we did have 64% of investor activity in Sydney. We had prices growing over the June quarter last year in Sydney by the highest rate in the modern era. So maybe there was a case there to take some heat out of that market. But interest rates were raised by the banks right across the board. Every capital city, every investor in every capital city paid higher interest rates. And it wasn't just new investors, it was existing investors as well. Now, I found that a very cynical exercise, to be quite honest. I don't think APRA, even though we will likely see the speed limit exceeded again this year, I don't think APRA will act, and they're making sounds now that they won't. However, I am concerned, and if you watch the TV news tonight, you'll see me speaking about this. I am concerned that the banks are now becoming players in the housing market by this hit list of winners and losers suburbs. This is a very, very concerning thing. The banks have now got a list of suburbs which they say, we're not lending there, we're not lending there, we're going to lend 50% there. Now, this is just, outrageous in the sense that it just exacerbates the risk or the underperformance of those suburbs that they've identified at risk. And I think this is a very dangerous environment for our housing markets, because markets such as Darwin and Perth, how do they recover if the banks aren't going to lend? Even if you're prepared to buy a house and happy to buy a house in a so-called underperforming suburb, if the bank says, sorry, I'm not giving you the finance, what do? You go to another suburb, and it just reinforces that risk profile. We need to ask the banks, A, they need to be transparent with their methodology. How are they coming about this? And of course, the other thing that happens is that, well, do we ask those that are in charge of the model, are there suburbs in the model?
So we've obviously got to wrap it up.
Yes.
It's been fantastic to have you on.
Sorry.
We could go for another 2 days, I reckon.
Well, I was just going to say, clearly a very, very passionate property commentator, but
why wouldn't you be?
Andrew did a presentation earlier this morning, and he's offered to give us a copy of his presentation. Yes. So if you go to the propertycouch.com.au, there will be a download available there. You can have a look through that. I had a look at the presentation from at the back of the room. It was some substantial data there. So we appreciate that you've come and joined us on the couch. And for those of you who haven't heard of the Property Couch before, if you've got an iPhone, you can go to the iTunes and subscribe. If you've got Android, on the Property Couch, we've put a video there on how to subscribe. But Ben's got a parting message.
Yeah, just put my Pippa hat on for a second. We're at stand 47. This is a petition for the government to regulate the property investment industry. If you haven't signed the petition, please do. We've obviously got an unregulated industry. We want to protect consumers and make sure that they're not being ripped off by spruikers. So if you sign that petition, we'll continue to keep fighting the good fight.
And if you join me in thanking Dr. Andrew Wilson for joining us on the couch today. Thank you. Well, there you have it, folks. How good was that? The content was unbelievable, and we told you that he could talk, didn't we?
Mate, he can talk, and there's angles and layers upon layers. So the content's great. You might have to listen to it a couple of times.
You might have to listen to it a couple of times, but if you're listening to this on the normal podcast, you can go to thepropertycouch.com.au and there'll be a video. If you're watching us here on the video, thanks for watching, and we will... No sign off?
No sign? No.
No sign. So we'll see you next week. Thanks, folks.